All right, let's dive right in. We're talking about a massive shift happening right under our noses in the world of finance. China is making a huge play for gold and, at the same time, backing away from the US dollar.
November 2025, China just completed 12 straight months of gold purchases while dumping $500 billion in U.S. bonds. For the first time since 1996, central banks now hold more gold than U.S. treasuries. Here are 3 scenarios for what happens next.
By the middle of 2025, for the first time in almost 30 years, the value of gold tucked away in central bank vaults officially became worth more than their holdings of U.S. debt. And look, this isn't just some boring number on a chart. This is a huge signal that the tectonic plates of global finance are shifting.
We've got to look at the numbers behind China's big strategic pivot. And trust me, this is a story that's been playing out for over a decade.
Now, the first thing to get straight is this. That headline you might have seen about a $500 billion dump? It's not like it happened overnight in some panic. No, this is the final chapter of a very long, very deliberate strategy. They've been slowly, methodically trimming their U.S. debt holdings by more than $585 billion ever since they peaked back in 2013.
So they've been doing this for a while, right? But the crazy part is they've just hit the accelerator. In just the last year, China has offloaded another $55 billion or so in U.S. debt. This isn't an accident. It's a clear policy choice that's speeding up.
Which really brings us to the billion-dollar question, or I guess trillion-dollar question, right? Why do this? Why would you trade the world's go-to financial asset for what some people call a shiny, ancient rock that doesn't even pay interest?
Well, it turns out it's not just one simple reason. You've got these push factors that are actively shoving China away from the dollar, and at the same time, powerful pull factors that are pulling them toward building a whole new system.
Okay, so first, the push factors. China is looking around and seeing a whole lot of risk tied up in the dollar system. And you know, the big wake-up call? It was Russia. When the U.S. and its allies just froze Russia's central bank reserves, it sent a shockwave to Beijing. The message couldn't have been clearer. Your dollar holdings are not safe. They're a weapon that can be turned against you. But here's the other side of it. China isn't just running away from something. They are running towards their own system. And they're building it piece by piece. Gold is the foundation. It's neutral. It's sanction-proof. But on top of that, they're ruling out the plumbing for a new financial world, like their digital yuan and their own CIPS payment system, which lets them do business completely outside of U.S. control. But here's where it gets really interesting. The Fed actually points something out that kind of throws a wrench in the dollar is doomed narrative. See, most U.S. debt isn't held by rivals like China. It's held by close American allies. We're talking countries with defense treaties and deep economic ties. They're not going to dump their bonds, which creates this incredibly stable base of demand that has kept the dollar on top for so long. So, what does this all boil down to? What's the real ticking time bomb for the dollar? Is it this global geopolitical chess match that China is playing? Or is it the sheer mind-boggling size of the U.S. debt itself?
Okay, so with all that in mind, analysts are basically mapping out 3 different ways this could all play out. Now remember, these are just probabilities, not prophecies, but they give us a really good framework for thinking about what's coming next. And, you know, what's kind of surprising here is that the most likely scenario isn't some crazy overnight collapse like you see in the movies. It's something much quieter, a slow erosion. Let's break down what each of these futures actually looks like.
So let's break these down. Path number 1, with a 60% probability, is this slow slide. Think of the British pound after World War II. It didn't just vanish, it just faded into being one of several important currencies. Then you have the more dramatic scenario, a 25% chance of a major shock that forces a return to gold. And finally, the least likely but still possible outcome, a messy, hybrid world with no single leader.
So, as we're weighing these 3 endgames, there's another giant player on the board, quietly making its own moves and preparing for whatever comes next. And that player is India. They're playing this incredibly smart, complex game. They're not betting on black or red, they're hedging their bets, strengthening their own position while keeping all their diplomatic doors open. And just like China, India has been stocking up on gold. They've just crossed that 880-ton mark. For them, it's all about creating options, having a buffer no matter which way the global economic winds blow. It's about flexibility. But here's the twist. Unlike Beijing, Delhi is publicly saying, hey, we love the dollar. This quote from their top diplomat says it all. It is the perfect balancing act.
They're quietly building up their gold reserves with one hand while publicly shaking hands with the U.S. with the other. They're keeping their ties to America strong while also being a key player in the BRICS group, which is actively trying to move away from the dollar.
And that fence-sitting from India? It's a huge wild card in all of this. Will they ultimately throw their weight behind a BRICS-led alternative, or will they stay neutral? The answer has massive implications. Which, of course, brings us to the question that probably matters most to you. What the heck are we supposed to do about all this?
All right, so if the giants of the world are shifting their weight, how do we, as individuals, make sure we don't get crushed? Let's look at what the experts are suggesting.
It really all boils down to one word: diversification. We're talking about putting a slice of your portfolio, say 5 to 15%, into gold. Looking at other solid currencies like the Swiss franc. Owning real stuff, things you can touch like commodities or real estate. Being really careful with those long-term government bonds that get hammered by inflation. And maybe, just maybe, having a tiny bit of Bitcoin as a what-if insurance policy against a major crisis.
So as you think about all this, I'm curious, which of these futures worries you the most? Is it the slow, quiet decline of the dollar, the sudden shock of a return to gold, or a messy, fragmented world that's just broken up into pieces? Definitely let us know what you think in the comments.
If you found this useful, support independent storytelling. Buy me a coffee, link below. This is Voice on Pages, where economics meets reality.